We finally have some of the answers to questions that we have about Celsius's growth in 2024, particularly in the second quarter. Is the company losing market share? Are sales going to drop? No, that's not the case. And there's a lot of details behind that. The management went into in pretty good detail on the conference call, but the second quarter numbers really tell the story. This is still a growth company, still taking market share long term, but there's a lot of noisiness in the data. And that's the reason that the stock is down over 50% since peaking in May. The scanner data was showing that Celsius was losing a little bit of market share. Sales were potentially going to slow in a really dramatic way. Sales growth is slowing, so I don't want to discount that. But this is still a really good growth company, and this is still a company that has a really bright future. So I want to go through the numbers, and then I'm going to end with valuation, because at the end of the day, any growth that a company has to be compared against the valuation that you're actually paying for the company. And Celsius shares have not been this cheap in quite a while. And I still think it's a really strong company fundamentally, but I'm going to go through everything today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the earnings report. I'm going to start with the press release. This is the high level numbers. Revenue was up 23% from a year ago in North America. Sales was 23%. Now, management did say that the Pepsi relationship, remember the last quarter, Pepsi was starting to reduce their inventory. When they started the Pepsi relationship, Pepsi is their main distributor in North America. Pepsi has to buy a bunch of product to build inventory in their channel. That then goes out to retailers, but they don't necessarily know how much product they need to have. So they basically overbought inventory early in that relationship, and then they're rationalizing and optimizing how much inventory they have in the channel over the past couple of quarters. So the negative impact management was expecting was $20 to $30 million on sales. Sounds like that came in at the low end, so about $20 million negative impact compared to what's actually selling through to stores. So the way that we talk about this is sell into distributors, and sell through is how much is actually being sold to end customers. So right now, Celsius is in a situation where the sell through, the amount of product that end customers are actually buying is higher than they sell into the channel. So there will be a normalization of that over time. Just want to highlight that dynamic. International sales was also up 30%. This is where there's a ton of opportunity for growth at Celsius. They're really just getting started. You can see that North America at $382.4 million in revenue, international just $19.6 million. This can be a massive, massive growth market over the next 5 years. What I thought was really impressive was the company's margins and then operating leverage, 52% gross margin. So this is, again, we've heard a lot about, is there pricing pressure? Is there too much discounting going on? Doesn't appear to be that way in the numbers right now. Net income was up 55% to $79.8 million. So even just for a quick and dirty calculation of valuation, if you just annualize this, so take this number times 4, you get $319.2 million in net income for a year. And that is 30.2 times earning. And that means that the company's market cap of $9.6 billion is 30.2 times earnings. So that's not all that expensive for a company that's still growing at 23%. And it's really a little bit higher than 23% when you talk about those inventory changes. So this is what I talk about. This is still a growth company. And now the stock is starting to look much more like a value. Now, management talked a lot about some of the tailwinds behind Celsius overall. One is that they're a leader in the sugar-free energy drink business. You can see that has grown in market share overall over the past year. Celsius is also accounting for about half of the growth in energy drink sales in North America. So this is really one of the leaders in the market right now from a growth perspective. They also put this into perspective with their two biggest competitors. Red Bull is in blue, Monster is in green. And this is the top 3 energy drink brands, US MULOC quarterly dollar share numbers. Again, dollar share. So their dollar share has increased significantly since Q1 2022, 3.6% to 11.5%. Now, what they are doing with this metric is they are adding in some of the e-commerce sales. So what they're trying to show here is that there's a little bit of lumpiness in the data in some of the MULOC numbers. In particular, convenience store sales seem to be very weak in the second quarter. So you add in things like e-commerce, things look a little bit better, and it's a little bit more of a holistic picture of the market overall. And again, there's lumpiness, but the trend, and this is just since the beginning of 2023, is higher for Celsius. This is where investors ran into questions. A little bit of weakness in the last month or two, but again, that doesn't quite show up in the numbers. And management talked a lot about how competitors are being more aggressive with some of their marketing. Celsius is going to need to respond. This is not going to be a company that's going to grow in a straight line up forever like it has over the last 5 years. But is the trend going to be higher? Is this 12% share going to be more like 20 or 30% in 5 years? If it is, then this is going to be a phenomenal investment. And here's that operating margin that I was talking about, gross profit. You can see that that is just trending higher and higher, 52%. Now there's going to be a limit to how far they can push this, but the asset light model allows Celsius to increase their revenue, increase their profitability without putting a whole bunch of capital expenditures in the ground because they use third-party bottling solutions. That operating margin, again, they're also getting operating leverage. That's now 23.4%. Again, management also said on the conference call that they're going to be spending a little bit more on sales and marketing in the back half of the year, hoping that that's going to translate to more revenue. But don't be surprised if margins come down on the operating side just a little bit because of that added expense. And this is always the balance with CPG companies, is how much do you spend on sales and marketing to drive revenue growth? How much do you pull back on that to increase profitability? There's a balance and kind of a dance that goes on there. But overall, these trends are really positive. And the final one I want to end on before looking at some valuation numbers is the US MLOC retail sales grew 36.5% from a year ago. So again, 23% revenue growth, but actual retail sales more like 36.5%. So there should be some pull through in revenue growth in the back half of this year just from that inventory normalization. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So Celsius's revenue growth is definitely slowing, but it's still well above what would you expect from just normal growth from a more mature business. And that's really where I think investors need to be thinking is, what does this company look like 5 years from now, 10 years from now? Is a price to earnings multiple of 30 reasonable for a company like this? And let's get some of those valuation metrics. These are numbers from FinChat, and these do not include second quarter numbers. Those have not been updated yet. But you can see that just the drop in the stock recently and the performance of the company over the past year has led that price to earnings multiple to fall from about 120 to 46. Now, again, that number should be significantly lower when you include the second quarter numbers. And if those margins maintain where they are, it will be even lower as the company laps some of the lower net income numbers from late in 2023. Price to sales multiple, that has consistently been around 10, peaked around 15 in early 2024. But now that is just 6.8. And again, that will be lower once the second quarter numbers are included. So the valuation for Celsius stock has gotten much better. I don't think the company is in nearly the dire position that a 50+% drop in the stock indicates. This is a stock that I own in the asymmetric portfolio. Definitely one that I would consider adding as I allocate more money over the next couple of months. We'll see where the stock price goes after this earnings report. But any sort of weakness and any sort of better valuation, I think definitely is a buying opportunity for a company that long-term should be in a really good position to grow. Now, there is going to be lumpiness in the numbers. That revenue number is going to come down from 20-30% growth. Don't be surprised that 20-25% growth is more like 15-20%, but that's still really solid. And especially as those international markets make up more and more sales, that's potentially where the upside is. But I think the valuation is getting really attractive and the business is in much better shape than the market thinks. But what do you think about Celsius's results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.